So next, coming to the what are the alternatives to the historical cost accounting? So there are two models are there. One is constant purchasing power, and another one is current cost accounting. So constant purchasing power, and another one is current cost accounting. So coming to the constant purchasing power. So in case of constant purchasing power accounting, in the general, while preparing the financial statements, so we consider, so like, so there are monetary items are there and non-monetary items are there. Monetary items and non-monetary items. So monetary items are nothing but which are easily converted into the cash. So are called as monetary, like cash or cash equivalent items like receivables and payables are covered under monetary, and the remaining fixed assets, inventory, these are all covered under non-monetary items. These are all covered under non-monetary items. So generally, coming to the non-current assets, so those are always recorded at what price? Those are recorded at cost, called as historical cost. In the subsequent period, these are recorded at cost less what depreciation. So this be what we call it as what book value. But for example, we purchased the asset on 1/1/2000 X1. So and the life of the asset is around 10 years. Then every year we provide the depreciation, and whatever the changes in the prices relating to the respected asset, those are not considered. Those are not considered. So if the financial statements are prepared by adjust by considering that adjustments for changes in the value of money, if financial statements are prepared by considering adjustments for changes in the value of money, then that method is said to be a what? Constant purchasing power. Constant purchasing power accounting. And it is also called as current purchasing power accounting or constant dollar accounting or general pricing level accounting. General pricing level accounting. So in case of generally non-monetary items, coming to the non-monetary items, those are recorded at what price? So at a historical cost. At a historical cost. So first, coming to the constant purchasing power. So in this case, so first these two items are there, monetary items and non-monetary items. So generally, these monetary items are subjected to the changes in value of money. So that market fluctuations are already reflected in the monetary item. So adjustment of the value changes in value of money is not required there. But coming to the non-monetary item, these are recorded generally at what price? Historical cost or at a costless depreciation value. So here market fluctuations are not considered. So adjustment of that change in the value of money is required in case of the non-monetary item. Adjustment is required in case of non-monetary item. And how the adjustments are applied? By using the general price index. So here what is meant by general price index? General price index is nothing but that index which consider the changes in the value of money due to the change in purchasing power. So that price index is considered, and that price index is used to calculate what CPP factor called as constant purchasing power factor. How to calculate? Index at the reporting date by index at the date of initial recognition. For example, so fixed asset is purchased on 1/1/2000 X1 for around 10 lakh dollar, and on 31st December 2000 X1 we have to calculate. Coming to the price index On 1/1/2000 X1, the price index is around 100, and 31st December 2000 X1, the price index is 110. The price index is 110. Then what is the value to be considered on 31st December 2000 X1 as per constant purchasing power? So 10 lakh into CPP factor. What is the CPP factor? Index at the reporting date. What is the reporting date? The date on which the financial statements are prepared. Nothing but that index is nothing but 110 by 100. So that is nothing but what? 11 lakhs. So in this way, this CPP factor is applied. The CPP factor is applied. So constant purchasing power. So this constant purchasing power accounting, so generally used. So to prepare the financial statements, by considering the adjustment of, changes in, by considering the adjustment of changes in the value of money, So here we discuss monetary item covers for cash and cash equivalent like account receivables or account payable. Non-monetary item covers rest of the thing. So coming to the financial statements, which items are required to be adjusted? So for example, income statement is there. In case of income statement, all items are required to be adjusted. In case of the cash flow statements, all items are required to be adjusted. But coming to the balance sheet, in case of balance sheet, monetary and non-monetary items, and monetary items are not required to be adjusted, and which items are required to be adjusted to the index? Only non-monetary items are required to be adjusted. Because monetary items are represented in terms of value of money. There is no change in the value because those are in term of money itself. Those are in the value of money itself. So there is no change in that value. Value. So this is about what? Constant purchasing power. Then, so here CPP accounting, coming to the advantages and disadvantages, CPP accounting, so is both simple and objective. It relies on the standard index. It adjusts for changes in unit of measurement, and therefore it is a true system of inflation accounting. So simply said, in case of CPP accounting, what happened? That inflation accounting is considered. Means the change in value of money is considered. Change in purchasing power is considered. It measures the impact on entity in terms of shareholders' purchasing power. Next. Coming to disadvantage, fails to capture the economic substance when specific and general price movements are deleveraged. And the unfamiliarity of information stated in terms of current purchasing power units. And CPP does not show the current values to the business of assets and liabilities. All assets are not adjusted for CPP. The general index used is not necessarily appropriate for all assets in all businesses. The physical capital of the business is not maintained. Because why the physical capital is not maintained? Because all are adjusted to the changes in the prices. Then automatically those are recorded generally at what is fair value. Then some inflations are there. That inflation is not available physically. Those are not available in physical cash. Next, second alternative to the historical cost approach. So second alternative to the historical cost method is nothing but what? Current cost accounting. So in case of current cost accounting technique is adopted in the place of current purchasing power of replacement of cost accounting technique for price level changes. So here what is considered in this case? Financial statements. Financial statements are prepared based on current values of individual item. So in this case, financial statements are. So that is nothing but what? P&L statement or income statement and balance sheet. Those are prepared based on current values of individual items. And so not at historical cost or original cost, not at historical cost or original cost. So current cost, what is meant by current value? What is meant by current value? Generally current value is nothing but if you want to purchase the asset at present, whatever you have at present, then how much amount required to pay, how much amount required to pay, that is considered. Okay, so it is based on what deprivable values or value to the business, and the deprivable value is equal to the loss suffered if the deprived of asset, and usually represented by replacement cost. So deprivable value is nothing but what amount? Replacement cost. Replacement cost is nothing but how much amount required to spend for replacing the old asset. So inventory and non-current assets are valued at deprivable value. So generally, inventory is valued at what? Net realizable value, net recoverable value. Non-current assets are generally valued at non-current assets are generally valued at what price? Cost less depreciation. Cost less depreciation. This is what historical cost method. But if your current cost accounting approach is applied, these are not considered. We have to calculate at what? Fair value, nothing but deprivable value. Monetary assets are not adjusted, and an additional change to the statement of profit and loss reflected in the referral of inventory within the cost of sale. So any change in, so due to the change in the value of non-current assets, or due to the change in value of inventory, those are transferred to the cost of sales. An additional change in statement of profit and loss reflect deprivable value of non-current asset. That is nothing but what? Depreciation. So due to the change in value of an asset, if any additional charge is created, best example is what? Revaluation. That is called as additional depreciation. Current cost accounting is not a single system of accounting. There are several variants. There are several variants. So the current cost, the first one, current cost statement of profit and loss is charged with the value to the business of assets consumed during the period. In particular, the charges for consuming the inventory and non-current asset are based on current rather than historical cost, as we discussed. So all individual items are represented at what price? So current value. So here, what is the current value? That is nothing but what? A replacement cost. Replacement cost. The current cost statement of financial position reflects current value of inventory and non-current assets. So these are the advantages and the disadvantages of CCA, current cost accounting. So this is about the two alternative methods to the historical cost accounting. So the last concept is capital maintenance, and this is also called as capital recovery concept. So capital recovery concept. So generally, capital maintenance is nothing but capital recovery. So it is an accounting concept based on principle that company's income should only be recognized after it has fully recovered its cost or its capital has been maintained. Okay, so in capital maintenance is nothing but it is a accounting concept. It is a accounting concept. So based on the principle that company's income, so company's income should consider only after it has fully recovering the cost or capital maintenance. So it is a theoretical concept which tries to ensure that excessive dividend are not paid in terms of changes in the prices. Excessive dividend are not paid in the because of changes in the prices. So a company achieves the capital maintenance when the amount of its capital at the end of the period is unchanged from that at the beginning of the period. Any excess amount above this represent what company's profit. Generally, so here we consider opening capital is there, closing capital is there. Closing capital is. So then capital maintenance is achieved only when if the opening capital and closing capital both are same. Any difference arises that we technically treated as a what profit. That we generally considered as what profit. Okay. So, and these capital maintenance, there are two types of the capital maintenance. There are two types of the capital maintenance. So one is physical capital maintenance, alternatively known as operating capital maintenance. And next second one is financial capital maintenance. Financial capital maintenance. So according to the financial capital maintenance, a company earn the profits only if amount of its net assets at the end of the period exceeds amount at the beginning of the period. So in case of financial accounting, in case of financial capital maintenance, so what it says, company and the profit. So how to define the profit? Profit is equal to net assets at the end minus net assets at the beginning. Net assets at the beginning. So this includes any inflows from or inflows or outflows to the owners, such as contribution or a distribution. Nothing but any additional capital is there and any withdrawals are there. Those are all ignored. Those are all ignored. It can be measured either in nominal monetary units or constant purchasing power unit. So in that case, so here, so in this case, two ways we calculated in two ways. While calculating the net assets at the beginning of the at the end of the period, we follow the two ways. So one is, so you may follow constant purchasing power. Constant purchasing power, and the second one is nominal monetary units. So in case of nominal monetary units, historical cost of net assets are considered. Historical cost. There is no price fluctuations are considered. So in this case, so price fluctuations are considered. Means price fluctuations means monetary items are taken as whatever they are available in the balance sheet. But coming to the non-monetary items, those are adjusted to the price index, and based on that revised value, non-monetary items, monetary item, we calculate net assets at the end of the year, net assets at the beginning of the year. The difference is treated as a profit. So we may follow either historical cost approach or constant power purchasing power approach. So we may follow any one of the method. We may follow any one of the method. But coming to the physical capital maintenance, it is not concerned with cost associated with actual maintenance required on the tangible items such as equipment, so our property, plant and equipment. Instead, so it does not relate into the physical availability of the assets. It is always focuses on the business ability to sustain cash flows into the future by maintaining access to income generating assets in use within the business infrastructure. So in case of physical capital maintenance implies that the company only earn the profit if its productive operating capacity at the end of the period exceeds the capacity at the beginning of the period. So any productive or operating capacity at the end of the period exceeds so productive or operating capacity available at the beginning of the period, then the difference is treated as a what? Profit. The difference is treated as what? Profit. So these are the two maintenance systems. One is physical capital maintenance and another one is financial capital maintenance. Okay. So these are the two capital maintenance systems. So relating to the maintenance of the capital. Okay. Then, so coming to the MCQs, wait a minute. So first one, which of the following which of the following measure so which of the following measurement basis are referred to in board's conceptual framework? What is meant by board here? So here the board is nothing but the new conceptual framework for the financial reporting that we technically called as what board. So there are four measurement bases are there. One is historical cost, another one is current cost, another one is realizable value, and another one is present value. This realizable value is also called as what fair value of an asset. Fair value. So the answer is B. Next, second, coming to the second one, Roscoe made a profit of 3,50,000 for 2000 X9 based on historical cost accounting principle. So Roscoe had an opening capital of 10 lakh and specific price indices increases during the year by 20% and general price indices by 5%. How much profit should Roscoe record? How much profit should Roscoe record for the year 2000 X9 under three different capital maintenance concept? So here three different capital maintenance are nothing but what? So generally there are two. One is financial capital maintenance and the physical capital maintenance. In case of financial capital maintenance, nominal money value, it means historical cost or constant purchasing power approach, and in case of physical. So then coming to the nominal money value. Okay. So coming to the nominal money value. So without consider, just we consider what historical cost here, historical cost accounting principle. So what is the profit as per historical cost approach here? 3,50,000. So as per historical cost approach, what is the profit we consider? 3,50,000. Then coming to the constant purchasing power, we have to consider what? So the changes in the purchasing power, the changes in the purchasing power, the changes in the purchasing power. So then how to calculate? So coming to the constant purchasing power, in case of the constant purchasing power, we have to consider, so general price indices. So for the maintenance of the capital, general price indices, we need how much? So 5%. So nothing but, so 10 lakh into 5%. So that is nothing but how much? 50,000. So actually, as per historical cost, what is the profit? We have 50. And for capital maintenance, how much amount required? 50. The total, how much amount? 3 lakh. So this is as per, so CPP. So means nothing but real cash, real financial capital maintenance. So real money flows are considered here. Real money flows means what? After considering the inflations. After considering the inflation. Then coming to the physical capital maintenance, it considers what? Physical capital maintenance considers specific prices, specific price indices. So here for specific price indices, what is the capital maintenance here? 20% is required. So means 10 lakh into 20%. That is nothing but what, 2 lakh. Then what is the total profit? 3,50,000 minus 2 lakh. Then how much? 1,50,000 is that. 1,50,000. So in case of financial capital maintenance, nominal money cash flows, nominal money values are considered. Okay. Then real money values, nothing but constant purchasing power by considering the changes in prices and physical capital maintenance. In case of nominal value, the maintenance, capital maintenance is not at all required. Then total 3,50,000 is the profit. This is historical cost approach. And in case of real money values are considered, means we have to consider price indices. So that too, which price indices, general price indices are considered. So for maintenance of the capital, 5% is required. 10 lakh into 5%, 50,000. So 3,50,000 minus a 50, nothing but 3 lakh. And in case of physical capital maintenance, we need to consider specific price indices, and it requires 20% for maintenance of capital. So 10 lakh into 20%, 2 lakh. So 3,50,000 minus 2 lakh, 1,50,000. So answer is so 3,50,000 under real cash flows. So but actual 3 lakh is, so A is wrong. And 3,50,000 is the nominal money value. And 1,50,000 is the real, actual real. In case of real cash flows, you have to consider 3 lakh. So this is wrong. So answer is C. C is the right answer. So which of the following concept measures the profit in terms of increasing the, in terms of what? Increasing the productive capacity of an entity. Nothing but what? Physical capital maintenance. So answer is what? A. So in physical capital maintenance, see clearly stated the operator productive capacity of an entity at the beginning of the year exceeds, at the end of the year exceeds at the beginning of the difference is treated as a profit. So which of the following statement is true relating to the historical cost in terms of rising the prices? Profits will be overstated, assets will be understated. In case of the rising the prices, so profits will be overstated, assets will be understated. So in terms of rising the prices, what happened? Generally, if the prices are increased, if the prices are increased, one minute. Okay. So in case of the historical cost of, for example, cost of the product is around 10 lakh and the useful life is 10 years. Then depreciation is equal to how much? 1 lakh. Then at the end of the year, 9 lakh. The prices are in increasing trend. Then the cost at the end of the year, increases in the market is around 11 lakh. But that increase in prices are not considered in historical cost. Then when you compare this 9 lakh with the 11 lakh, the assets are what? Understated. The assets are what? Understated. So then profits out of assets are understated means the depreciation charge is reduced. If the assets are understated, then charge on that asset is also low. Then automatically profits will be overstated. Okay. So just imagine I purchase a phone. So for rupee 1 lakh. So after 1 year, the price of the phone is increased as the prices are in increasing trend. So the phone price is around 12 lakh, 1,20,000 is there. But if I follow the historical cost method, I have to mention that price of the phone at 1 lakh only, 1 lakh less depreciation. So when we compare the purchasing price with the increase in price, the asset is understated. Then automatically the charge on that asset is also understated. Then automatically the profits are increased. So this is about the conceptual and the reporting framework.